Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, July 2nd, 2024 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for yet another market open. This is the first show we've had since the second half of 2024 began. I thought the first half of 2024 went about as planned. Back at the beginning of the year, I thought we'd probably be somewhere around 5,300 at this point, and we're actually 5,500. So the market has done a little bit better than what I thought we would do in the first 6 months. But I think we'll probably still hit a rough patch probably in the middle to late summer. I'm thinking maybe late August, even into maybe early September, maybe throughout the month of September. I think we're already starting to see a little bit of drama playing out in the presidential election race. And I think that's something that as we get closer and closer to the actual election, that could be something that the market struggles with. And we could see, I don't know, somewhere between 5, 7, 8%, something like that to the downside. Wouldn't shock me. But I'm not looking for that now. I'm not seeing any signals short term that suggest that's about to happen. And I think as far as, looking further down the road, the long-term signals still look pretty good as well. So I suspect we'll probably see some things develop between now and the latter part of summer. And we'll try to, keep you up to date as best we can on that. Futures this morning are down a little bit. Right now, actually, let me give you the latest. So right now, the diamonds, the DIA that tracks the Dow Jones, currently down about 0.2%. The spider is down a little bit more than 1/3%. The QQQ, of course, a little bit more aggressive, tracking the NASDAQ 100, down about 0.4%. And small caps actually bucking the trend, at least for now, relatively flat as we go into this Tuesday. So overall market, I think, doing okay. Again, futures down a little bit this morning, but we've just been doing this slow move to the upside. We have seen the VIX. Let me pull that up for you. The VIX right now closed yesterday at 1222. So this slow, steady movement to the upside where we have a little bit of, maybe morning selling, and then we come back, or maybe we gap up, then we gap down, or then we sell off a little bit during the day, but still resulting in these little movements back to the upside. That's kind of what I expect when I see a volatility index down in the 12s. Once you move down below 13, as I've posted about, I've written about, I've talked about, volatility index is key because it's giving us a signal from the market makers. The market makers tend to manipulate data or manipulate stock prices. And when they're giving us a clue that there's really not a whole lot of volatility expected, and that's what the VIX tells us the expected volatility over the next month or so. So when you get a really low VIX, the market makers are sending the signal there's probably not going to be a whole lot of volatility in the next month. And when that happens, when you have little volatility, you also have little selling. So anyway, take it for what it's worth, but the VIX does give us some pretty good signals, as I've written about. I've actually, gone through and checked out the way the S&P 500 performs when the VIX is at various levels. And the S&P 500 does its absolute best. Now, this study goes back to the beginning of this secular bull market. But there's no doubt the S&P 500 does its absolute best when the VIX is below 13. And right now, again, we're at 1222. So as we go into this second half of the year, I do think the market's still set up for potentially a little bit more drift, if you will, to the upside. I don't think we're going to go screaming higher. I think the semiconductors, which helped us a lot in the first half of the year, I think that area of the market could be a challenge in the second half of the year. And then, so we've got other areas that are going to have to pick up. If there's a lot of money coming out of semiconductors, literally there's like one of two things that can happen. Either that money stays out of the market and it takes our major indices lower, or it rotates. And if it rotates, and that's what I believe is going to happen and is happening, then we need to be prepared for where that money is rotating into, or where it could rotate into based on what we're seeing in terms of relative strength. So I've talked a lot about software of late. I really like software groups. So that'll keep some of the money in technology. Computer hardware, Apple. I wouldn't be surprised to see Apple continue to push to the upside and driving computer hardware higher. Apple, by the way, loves the month of July, also loves the month of August. And I'm talking in historical terms. So those 2 months have tended to be very strong months for Apple. And we got off to a pretty good start yesterday with Apple kicking off July. So anyway, those are a couple of areas that I'd watch. Tesla, I really like. It got right up to a key resistance level around 210, 211 yesterday. Put the brakes on right at the close. I saw that was down this morning pre-market. Tesla, actually, no, there must have been news out since I looked last. Tesla up $9 in the pre-market, now up to 219.22, and that may have just come in. QQQ's moved back down a little bit, only down 0.39%. It was a little over 0.4. But Tesla getting another big push. And by the way, this is not unusual for Tesla to make a move into earnings. I've talked about that recently. Don't ask me where I've talked about it because I talk about things in a lot of different places. But I have been talking about Tesla and the fact that it does make big run-ups a lot of times into earnings reports. Of course, they've got their earnings coming up in a little more than 2 weeks. And we are definitely in a move. I'll show you the chart on Tesla in just a little bit. All right, let's go ahead. I'm going to set this up so everybody can follow along here. All right, let's take a look at the action here. You can see the Dow Jones Industrial Average finished up slightly yesterday. And this is kind of like the action we get when the volatility index is down, to the level it is right now. Dow Jones up 50 points, 0.13%. S&P 500 up another 15 points, closing at 54.75. It's not an all-time high, but we are, again, moving in the direction, getting close to all-time highs on a closing basis. But that was a rise of a little bit more than 0.25%. The NASDAQ 100 rose yesterday 0.66%, which is roughly 2/3 of 1%. Mid caps losing 1%, a little over 1%. Small caps down a little more than 0.8 of 1%. So definitely out of favor again were the mid caps and small caps. And then transports falling about 0.75 of 1%. But at least for now, transport's sitting above the key moving averages. We've done this a few times here over the last 3-4 months where we go through the moving averages and then right back down below. We go through and then right back down below. And here we come right back up through. The last 2 weeks, transportation has been leading these other major indices that I've been showing you. So that hadn't happened in a while. But we've had a couple of solid weeks out of the transports. And again, what a lot of people don't realize is that the transports and the S&P 500 go hand in hand. I'll come back and we'll look at the rest of this information, the summary in just a minute. But I wanted to show you a chart on transports, and I'm going to bring up correlation. Because the problem is a lot of folks when trading the market have a very short-term memory. Most traders are only remembering what they've seen recently. They don't really understand perspective, the long term, the way the market usually works. And so if they see something that's happening that's not the way it normally works, they forget about what normally happens and they just go with what's been happening. So there's a lot of folks really down on transports. And hey, as long as this downtrend remains in play, I'm down on them too. But I know how the market usually works. And what we normally see is transports and the S&P 500 working together in the same direction. But let me pull up that correlation and update. Let's go out. Well, let's just go out 10 years here. If you look back at this chart, you'll see at the bottom, this is the correlation. So make it bigger there so you can follow along here a little bit. But the correlation since back in 2014, you can see that we remain above the zero line almost all the time. 2017, we took a couple big dips. 2018, we had one at the beginning of the trade war. November, maybe early December 2019 had one. And then you can see more recently a few, maybe 5 or 6 times over the last 5 or 6 years. So probably averaging about once a year, maybe a little over once a year. But anyway, what we just saw recently was inverse correlation between the transports and the S&P 500. I'm not going to say it doesn't happen, because we can look back and we can see that occasionally we do go below the zero line. But what I want you to focus on is how often we sit up here between about 0.75 and 1. That is telling us that these two indexes or indices tend to move hand in hand together over long periods of time. And the norm is for these two indices, the transports and the S&P 500, to be heading in the same direction simultaneously. So when we look at what's been happening in 2024, or even in the latter part of or the second half of 2023, you can see we've had multiple situations where we've seen the correlation go negative or inverse. And so that's got a lot of traders thinking that, the market's not in good shape because the transports haven't been performing well. That's generally not the case, because normally what happens is we play catch up. And it looks like that's what we're starting to do here over the last couple of weeks, where all of a sudden now we're moving back into, hand in hand type of a relationship. S&P's been going up, transports have been going up to lead. So things are starting to get more normal again there. And I'll want to continue to follow this. Now, transports probably are going to be down today, because right now we've got S&P 500 futures down. But if we reverse, we see the S&P go up, watch transports. If money's rotating out of semis, this could be an area. Transportation could be an area that's been lagging for a while. But again, you can see that long-term positive correlation that sits up here, usually up near the 1 level. So anyway, just wanted to kind of point that out. I think that that's something that, like I said, is overlooked. We tend to only look at what's happened recently. We don't have the ability to use perspective, or maybe some traders don't know that history. But anyway, I wanted to point that out, because yes, technology's been weak. Yes, they've been lagging. Yes, I know all about the Dow theory. But it's not like we haven't seen this before during this current secular bull market. That's my point. It's not completely out of character. It happens from time to time. Technology leading yesterday, up 0.75%. Nice to see the technology group do pretty well. We did see a bounce off the 20-day moving average. We saw another kick save on semiconductors at the 20-day moving average. We were down below. It looked like semis were getting hit again, and then they came back up late in the day to hold the 20-day. So maybe we're still in that sideways consolidation mode for now on the semiconductors. That no doubt would help technology, but I think we're probably going to roll back over again at some point on semiconductors. And when that happens, does that money continue to rotate in bullish ways and in bullish areas? Another bullish area would be discretionary, which led yesterday, was up about 1/3 of 1%. The interesting part about discretionary, and if I think about it, I'll try and pull this up in just a second, is that if you look at discretionary yesterday, you saw Tesla have a big day. You saw Amazon have a pretty good day. Those two stocks account for about 37% of the XLY. So the fact that it was up 1/3 of 1% with Tesla flying and Amazon flying should tell you that the rest of discretionary really wasn't that strong. And I'll show you the breakdown in discretionary here in just a minute. Let me just go through the rest of these charts quickly. Financials up about 0.2% yesterday. JP Morgan nearing a breakout. Remember all the talk about CEO Jamie Dimon, the fact that he was no longer talking about his 5-year plan. And so the whole market made a big deal about it. We quickly went back to about 195 from 205. And I said, this is an opportunity. It's just noise. I mean, it's just too early to worry about it. We don't even know who Citi who Citibank might look to replace, or excuse me, not Citibank, JP Morgan. We don't even know who JP Morgan's going to use as the successor to Jamie Dimon. It's just way too early. We're talking about something that's likely to happen over the next 3-4 years, not 3 months. And so I thought the whole thing was overblown, and now we've got JP Morgan right back up to where it was before. So sometimes it's part of trading is just taking news that gets blown way out of proportion and just following the actual price chart, the fact that it's still okay technically, and then you see JP Morgan bounce right back. Anyhow, that helped lead financials up 0.22%. Autos, another big day, as I mentioned with Tesla. I mean, look at this. Now all of a sudden, it looks a little bit like a bottoming head and shoulder pattern, left shoulder, neckline, head, right side of the neckline, right shoulder, and then breakout, lots of volume. This right here would measure somewhere, but I don't know, probably 200 points higher to about maybe the 940 level. So autos, I think, are looking pretty good. And of course, Tesla with its move this morning, certainly going to help the calls there. Computer hardware also did well yesterday. I mentioned Apple earlier having a nice day yesterday. Computer hardware up nearly 3%. And then software, this is a group that I'm really looking for some strength out of, not just in July, but really maybe to kind of take that baton from semiconductors. I think this could be one of those areas. And what I've pointed out recently is that if you look back during the secular bull market, software has had some of those moves, especially back in about 2015 to around 2019, 2020. If you look at the relative strength of software back then, software absolutely was exploding relative to the S&P 500, and it was helping to carry the S&P 500 to the upside. If you look at a relative chart to where we are right now on software to where we were 3 or 4 years ago, I mean, we've had periods of strength, but we've also had periods of weakness. And on a relative basis, we're sitting almost right where we were 4 years ago. So we haven't seen that relative strength in software. On a relative basis, it's just been going along with the S&P. It really hasn't been showing leadership. But we just made a key breakout on the absolute chart that I was talking about or have been talking about. And we also broke a downtrend channel or a down channel on the relative chart of software versus the S&P. So if you can just kind of picture it, it's just been this channel where software has been underperforming while the market's been going up. Semiconductors have been leading. Money's been coming out of software. Well, we broke that down channel, and now I believe software is starting to see that rotation come into it. And that could be something that sparks this group for potentially a long time. This might not just be a month or two. This could be many months. It could be a few years that software makes this big push to the upside. So I just think everybody needs to be aware. That looks like that's what's happening to me. I'm seeing money coming out of semis, and I'm seeing money going into software. So this is one area I'd certainly keep a close eye on. All right, I wanted to show you that sector analysis. So let's go here and take a look at the consumer discretionary, because it really wasn't as strong as you might think. So if we look at the sector summary yesterday, you can see that I just went over technology, consumer discretionary, and financials, because there they are leading. Technology on a percentage basis, 0.76%. And there's your consumer discretionary, 0.34%. So on a day when the market didn't go up that much, that seems like discretionary had a really good day. But if you click on consumer discretionary, it'll break down the industry groups. Take a look at the industry groups yesterday. Only 3 went up. We're getting a little bit of a dead cat bounce in footwear because Nike absolutely got trounced last week with its earnings. So we saw a little bit of a rebound there. There's your broadline retailers. That's Amazon's home. And there's automobiles. That's Tesla's home. Those were really the only 2 areas that did anything. Again, footwear is not, I mean, look at the scooter score on footwear, 0.8. It's about as bad as it gets. So not really looking too much at this, but automobiles are improving, and broadline retail is one of the strongest areas of the market. And then apparel retail with a scooter of 91.2 was flat yesterday. So we're getting some strength from areas that have been strong recently. Then we have some improving, like automobiles. And then we had one that was just bouncing because it's been so horrible that we just got a little bit of a bounce. I wouldn't read too much into that at this point. But go down the list here, or we could just flip it. Click on that percentage change column, and now we see what didn't work. So recreational services, which have been strong, we are seeing that pullback there. And so that's something that I think, hold on one second. I actually have been waiting for a call. So I just want to take 1 minute, if you don't mind, and try to answer this call. 1 second, please. Okay, sorry about that. I make sure that all the screens are up and you can see okay. Yeah. I was waiting for a call. I thought it would come probably after 9:30, but I wanted to make sure I took that. Anyway, thanks for your patience there. Anyhow, recreational services, you can see down 3% yesterday. This is a group, like I said, it's been very strong of late. It's got that scooter up over 80. So while footwear is kind of doing a little bit of a rebound, recreational services doing a pullback. I think that is something that could be viable in the near term. So if we pull up this chart, and I'll pull that up right now, you can see we just had a breakout, and this pullback's actually getting us right back to the area of the breakout and perhaps back down to the 20-day moving average. So I would not expect this group to be down long before another move back to an all-time high, or not an all-time high, but move back to a high. So that definitely is a group that I would keep an eye on that did not do well within that discretionary group. But as you saw, a lot of those areas within discretionary did not have a very good day yesterday. All right, 10-year Treasury yield. Yesterday, we had a pretty big push to the upside, but today we're giving a lot of it back. So you can see 10-year Treasury yield. Let's get an update here. Currently at 4.42%. And the 10-day, 5-day, 10-minute chart, you can see here, we moved up. It was a big move higher. We got back up to close to a recent high, but then we pulled back this morning. So, and I was looking, didn't quite have time to get into the economic reports. Yeah, really not anything coming out. We do have Fed Chief Powell speaking this morning at 9:30. So if something happens after 9:30, could be something he has said or done, or maybe the market takes off. Maybe he's, starting to see all the signs that the market is sending him, telling him to start cutting rates, telling the Fed to start cutting rates. I don't know. Just wanted to let you know that he will be speaking here very shortly. All right, not a whole lot else really to talk about there. I do want to make you aware, though, we do have the ADP employment report coming out tomorrow. And we've also got the bigger report is the non-farm payrolls on Friday. So just be aware. And then Thursday, we have a holiday. Markets closed for July 4th, Independence Day. So we won't have anything going on Thursday. But yeah, the rest of the week, we do have a couple of key economic reports coming out both Wednesday morning and Friday morning. That will likely have, or could have, a pretty significant impact on both the bond and the stock market, especially that Friday report. Jobs expected to come back down a little bit from last month, but we had a big surprise to the upside, if you remember, last month. So we'll see what happens. But all the inflation data has been coming in much lower, kind of pointing us to that 2% target. It's going to be very interesting if the jobs report does come in stronger than expected, how the market reacts to it. All right, S&P 500. On Friday, you can see we had that false breakout. We pulled back. Today, we're down a little bit. I don't know. We could see a 20-day test. We're not talking about going down too far. That would be about 1% just to get us down to the 50. And we're down 0.4 pre-market. So something like that would be certainly palatable, probably be an opportunity to buy into some of your favorite stocks on pullbacks. NASDAQ 100 did rally and finish up near its high of the day, though it also posted an all-time high intraday on Friday, only to give it back at the end of the day on Friday, and then also yesterday went to a lower low, but we did finish strong. So if you look at the chart, 10-minute, 5-day chart, you can see we were down in the morning. We did rally back, though, close at the high of the day. I just don't know, getting the gap down. This could be the start of a short-term little pullback that maybe takes us back to 20-day tests. IWM. So IWM has been kind of like all over the place, but mostly just sideways. Today, let me give you that latest because we open here in 5 minutes. And right now, the IWM is up 7 cents, 201.26. So it's going to open right about where we closed yesterday. And then the question is, where do we go from here? We've got support down around 198. Of course, that big resistance level is just above 210. Let's get that close above 211. The next major resistance above 211 would be all the way up to 235. So, I talked a little bit about the TNA with members. I think we talked maybe a little bit about it in the trading room last week, I believe. And we do have our trading room coming up again tomorrow. But I think if the TNA, if we get back through that 211 area, I think that would be a great time. Or anything back down in this 198 to 200 area. If you're looking for leverage, that's where I would do it. If the recent lows don't hold, I'd be right back out of it. And if you get through the 211, I'd probably, you got to be willing to give it some room as it moves up. That 20 days is going to move up. So I probably on a breakout would give it a little bit more room. I don't want to give it much room on a breakdown, but on a breakout, I could give it back down to that 20-day. I may take half position. And if we do go to the 20-day, I may take a full position. Haven't been talking a lot about that leveraged ETF though, but I'm still watching it. I do trade it occasionally, but I'm not really holding it. If I can get anything out of it, I'm pretty much just taking profits, moving on. But those that range that we're in right now is one to watch on the IWM. I believe it's going to break to the upside, but we do have to continue to monitor it. Transport. So this is what we talked about earlier. There's that move over the last couple of weeks. We've been seeing some strength. We're starting to see that correlation to the S&P 500 move back into positive territory. And if it can get all the way back up to 1, that would be very good news. It's either going to be great news because the transports have followed the S&P to the upside, or it's going to be bad news because the S&P 500 has finally said, okay, can't keep going up with the transports not participating. So the way you solve this and get back to positive correlation is either for the S&P to roll over and follow the transports lower, or for the transports to turn up and follow the S&P 500 higher. My bet would be on the latter, but just wanted to point it out. It is something to keep in mind. All right, if you go over to earningsbeats.com, that's my home. You can start a no-cost 30-day trial for our full service. I can tell you our members are extremely happy and have been for a while. We've kept them out of harm's way throughout this secular bull market. We completely missed the cyclical bear market of 2022. We were down for 9 months. In fact, most of the discussion back then was shorting any rallies. So even though you might been watching the show for the last year or two and think, oh, he's always bullish. It's not true. When it's time to be bearish, I'll be bearish. And what the odd thing is, everybody else was bullish. When I turned to bearish at the beginning of 2022, everybody was on the bullish side. We had gone up on the S&P 115% in 22 months. Why wouldn't people be bullish? Just making money hand over fist. But the warning signs started coming in, and we did have that cyclical bear market to follow. Right now, I don't see those warning signs. I think we continue to go higher for now, although with the VIX so low, it could be a very slow, steady kind of a move. We pull back, bears get a little bit excited, and then we back up at another new all-time high slowly, of course. That's really what I'm expecting at this point. Anyhow, if you scroll down, you can sign up also for our free newsletter. And if you haven't followed our work closely, that's probably the better choice, just to get used to what we do and how we approach the market. Our tagline is better timing, better trades. And it really comes out in EB Digest. I mean, that's where I'm usually trying to show how stocks have pulled back to key levels or where would be good entry points, that sort of thing. Name and an email address, all it takes. Monday and Wednesday mornings is when we deliver this now, twice a week, and give you an idea, like I said, how we approach the market, and I think provide you some more ammunition for trying to become a better trader, and hopefully a successful, profitable trader. But check that out and sign up for that if you haven't already. I wanted to just show you CrowdStrike. This is one I talked about last week. I love software. I've said before, I think this is probably my favorite stock. If it's not my favorite software stock, it's right up there at the top of the list. Hard not to like Microsoft. But right, and ServiceNow is starting to pick back up again, has been strong of late. But CrowdStrike made the breakout. This is when software wasn't even in fashion. It was going down relative to the S&P, and CrowdStrike was breaking out. Now we're starting to see strength, and I believe we're going to see a breakout. We did have the highest close by CrowdStrike ever yesterday, so we did finish strong. Volume was just so-so. Let's see if we can get a little follow through there today. A couple other stocks I'll give you before we wrap up here. JP Morgan, that was the chart I showed or talked about earlier. There's your move back up. So here was the day when Jamie Dimon said, I'm not going to give you my 5-year plan because basically I don't plan to work 5 years anymore. And that just spooked everybody. One day down, we ended up going a little bit lower, but look where we are right now. All that was an opportunity to get into a leading stock that has done well over many, 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 many years and pays a nice dividend. So a lot of times it pays to use weakness like that to increase a position or to start a position. Anyway, Marathon Digital Holdings, wanted to bring this up. Closed yesterday at 22.56. If you go back over the last 3 months, there was one close right here at the end of March. We closed at 22.58. So we are 2 pennies. We closed 2 pennies below, but look at the volume picking up. This is one, if it gets through this 22.60 area and can close above that area, I mean, it shows that it can move very fast on a lot of volume. I mean, it's not out of the question to think this stock could be back up in the low 30s if it makes this breakout. So just wanted to point out the increasing attention that it's getting, the added volume, and the beautiful day yesterday up 13.7%. All right, that is essentially it. I'm going to go in here and take a quick look at the market. The Dow down a little bit more than more than 0.1%. S&P 0.2%. NASDAQ down almost 3%, or excuse me, 0.3%. NASDAQ 100 though down only a little bit less than 0.2%. The VIX up a little bit, still well down in the 12s. Again, I think the market's set up. Small caps are the only key index at this point that's higher. You can see at the top of the S&P 500, Tesla up another almost $11 today, another 5% on top of yesterday's. Good action there. I see on semiconductor, so there's one semiconductor name up there. I'm not really seeing any others though. And then S&P on the down list. Well, NVIDIA down a little bit there. CrowdStrike actually pulling back today, maybe giving another opportunity in the lower 380s. Teradyne, TER just fell off the list, but that is also a semiconductor stock. There's Qualcomm Semiconductor. So semiconductors still, a couple of these leaders here not performing well, and I'm a little worried about the group for a while. We'll see what happens. Anyhow, that's it for me. I appreciate everybody tuning in. I'll be back next Tuesday for your next Trading Places Live show. And then, of course, this Thursday will be my second show over at Stock Charts. For those of you, I know there's some of you disappointed we're not doing these shows 3 times a week. Trying to free up some of my time a little bit on Wednesdays. It really is helping me not to have the show so I can prepare for our live trading room for members. And again, if you sign up for our 30-day trial, you can come into our live trading room the next 5 Wednesdays. So that's something to consider. Not a bad deal when you consider it's for free for 30 days. Anyhow, certainly check all that out. But then Thursday, I'll be doing a recording. I'll probably record, since it's a holiday, I'll probably record it a little bit early, maybe on Wednesday, and then probably have it posted sometimes on Thursday. So when you want to make sure that you are getting the latest stuff from me, earnings beats, or stock charts, make sure you subscribe to our channels, earningsbeats.com, and then also stockcharts.com on YouTube. Subscribe to the channels. Make sure your notifications are on. And that way, when we do publish our publish videos, you'll get those timely. But that's it for me. Have a great rest of your week, everybody. Enjoy the July 4th holiday, and I'll see you again here on Trading Places next Tuesday. Happy trading.